online lending technology think tank. My name's Colin White and I'm from Credit Connect Media. For those of you who just tuned in, you missed the first session earlier where we talked about credit risk and the cost of living challenging. Some really, really good conversations on there. I'd recommend people, you can watch again actually within the next 24 hours. We'll share a link on that on LinkedIn. But yeah, really great session there, and I'm sure this one will be great too. So we're going to be shortly talking about open banking and the future of lending. But really quickly, before we get to that, I wanted to quickly run through the interactive screen that you've got in front of you. On the left-hand side, you've got a series of icons on there. Press the I for more information about today's event. Obviously, it's all in front of you there, but also we've got click on the person kind of icon, and that's got information on the speakers today. So a bit of background to them. You've got a bit of information. You can click on a logo for more information about Credit Connect and our future events, and from background to our sponsor of this session, which is Acquired. So I recommend you have a look at their link as well. And then you can click for further information as well. But the important icon there is the speech bubble. We'd really like you to ask some questions. We didn't get lots in the last ones. We do some events, we get like 8 or 9. So it'd be really good to interact and get your thoughts on that. There'll be only a couple of polls in this session, so it'd be great to get people's feedback on the polls as well. It'd be really good. We'll cover those in the event review that we're going to write up this time next Thursday on the Credit Connect website. So it'd be great to get your views and questions through today. And then socially, it'd be great if you're enjoying this. Please use our hashtag LendTechTT. And we'd like to see you interact on there as well if you can. So, but let's move forward. Let's get on with the next conversation. As I mentioned, it's sponsored by Acquired.com, so we'd like to thank those guys for that. But also, we'll hand over now to Chris Warburton from RO Strategy, and he will introduce our great panelists who we've got in this session. So, Chris, over to you. Thank you.
Thanks very much, everyone. Really appreciate it. Thanks, Colin. So this session here, we're going to be talking a bit about open banking and lending technology. With us on the call, we've got Alex Marsh, who's the non-exec director from Salad Money. We've got Jon Timmis, who's the chief CEO of BTR Future and risk acquisition advisor for Ezoo, should I say. We've got George Badejo-Adebenga. I think we got that right, George. He's the CEO from Money in Minutes and has a huge amount of experience around compliance and regulatory kind of issues in the UK as well. And we've got Justin Hanna, who's the head of direct sales from Acquired. So thanks very much for joining us. I mean, I suppose on the last session here, we talked a bit about open banking. We talked a little about lending technology in the context of things like affordability. We've heard a lot about that, I suppose, over the last sort of the last few years. But I suppose, what maybe just to start off this session here, is it like, what are some of the things that people have seen? I mean, sort of open banking fitting into affordability. I mean, Alex, what are some of the things that maybe you've seen sort of in your sort of wider your sort of like wider engagement, particularly with things like Salad Money, where I think you use open banking fairly often?
Yeah, absolutely, Chris. So just briefly, those who don't know Salad Money well, essentially all underwriting is through open banking capabilities. So it's not utilizing sort of traditional credit reference agency data. And so what are we seeing? So at Salad, obviously, I'm sure discussions already, a huge rise in demand, as a starting point. So as part of that sort of going into affordability assessments, huge rise in demand from consumers, and all the trends are known there in terms of post pandemic cost of living crisis, exit of many alternative forms of credit, whether that's high cost short term credit. That has driven a rise in demand. We primarily serve those who are in the near prime, subprime space, who maybe have challenges in their credit file, which is why using open banking capability works. If you then zone in on those who do apply, interestingly, significant uptick over the past 18 months on those willing to use and share their data through open banking to be part of an affordability assessment. I think, again, if consumer trust has grown in terms of understanding what open banking is, the willingness to share if there are benefits for them from sharing. So we're seeing a higher rate of consumers who kind of come in the application flow, who then do proceed through to application because they realize they need to share their data, they're willing to because they see an upside in terms of potential ability to be approved. The reality is, given that higher influx in, that we are seeing much greater trends in terms of those where they're not meeting the affordability criteria. That is just the reality of what we've seen, and it's kind of unsurprising because it's a different demographic coming through. They are seeing their particularly salary not necessarily rising at the same rate as they are with their living costs. That's impacting ultimately then the affordability. I think the real benefit though at the moment that we're seeing through the assessments we are doing is that those marginal cases where by sharing the data it is meaning that they can get accepted and can avoid them having to go to the growth in illegal lenders and other forms of credit, which obviously we would not be encouraging consumers to use.
And I suppose in terms of like adoption of open banking technology, it sounds like that's increasing, but it's allowed you to differentiate more and probably get greater, faster insight. I mean, Justin, it's like you're kind of like close to that from an open banking point of view. And what are you seeing in terms of like adoption rates? Have we sort of like crossed the threshold we talked about on the last session? Have we crossed the threshold over mass adoption?
I'd love to say yes to that, Chris. I think consumer behaviour is being driven by open banking more and more every single day. People are seeing it, they're hearing it. The term open banking makes some people a little bit nervous. I think it does. However, if you're wanting to lend and borrow, then I think open banking is key to allow you to borrow what you need to borrow. And I think if we're going to ethical lending, right, it fits into that hand in hand around allowing someone to borrow what they need, not necessarily what they want.
Yeah. And I suppose, do you see any kind of like changes in trends like around that, like Alex was saying, in terms of like within the data? I mean, we can get to see that so much quicker in terms of like, is affordability changing, or even like signs of things like a vulnerability?
Yeah, look, data is always going to be key, and the AISP segment of open banking is allowing businesses, once they lend, then when it comes to collecting, also understanding that customer. Which I think is then key for further lending, especially.
Yeah. And George, I suppose from your perspective, I mean, we've had a lot of focus on things like customer duties there, I suppose, in the background now. But in terms of like looking around, affordability, using data to then kind of assess that affordability. I mean, where do you think we kind of sit now from a technology point of view, and using that technology to really determine things like fair outcomes? Or you're on mute.
Yeah, sorry, Mike. Yeah, I think the change that we see today is pretty much driven by, or partly driven by, consumer expectations, right? So this technological enhancement or drive, it's because this particular generation do not have time to wait. They want responses instantly. From a compliance standpoint, I think it does two things, right? It addresses the issue with regards to making wrong decisions, so reducing harm to consumers. And also a particular problem we've always had is access to credit. Right. Even though in the UK, where we've really kind of improved significantly, there's still a lot of people due to different biases that not having access. And I think that's where open banking and this kind of technology helps. So it's actually ticking the compliance side of things in terms of regulation and unfair outcome, but also making finance accessible to a lot of people if people can actually see the benefits. Having access to a lot of data is absolutely important. Another thing that we don't tend to talk about with regards to open banking, which I've recently realized, is not the fact that it can allow you to see a lot of data and then make decisions on who to lend to or not to lend to. Importantly, it can allow you to actually figure out the right product to develop for certain size of people that we're saying no to at the moment. Because whether we like it or not, people need finance. And whether we like it or not, if we say no to all these people, they're going to go elsewhere. And this elsewhere is perhaps unregulated entities that would even cause more harm. finance they still need, whether we like it or not. So can we use this technology to solve problems of people that perhaps, yes, we naturally cannot lend to, but there could be a product that is right for them. And that is the way I see it. And that's that balance insofar as compliance and also accessibility, which is also a huge problem as well.
Yeah, I mean, you talked there a little bit around, suppose, technology adoption and sort of that feeding back into like expectations of consumers when they're borrowing. I mean, Jon, I get you to comment a little bit around that, which is, I mean, is that fundamentally changing the nature of people who are applying for credit, and are we almost like getting almost like this almost like two-stage or two groups of people who are like very tech savvy and they want to do everything through their phone, and we've got markets that can apply for that, and then we've got people who maybe aren't quite so much. And how do we sort of think about that?
I think there are going to be kind of separate groups to some degree with any new technology, whatever. The younger generation, the people that are more tech savvy will be the ones who early adopters for any new technology. It doesn't matter whether it's finance or whatever. So you are going to get the separation off. And I think we're still in the early adopters kind of part at the moment in time. But the younger generation are more willing to kind of give over their data if they think there's a good exchange in relation to it. And the same as the tech savvy thing is. But I think it's a bit like the kind of when chip and pin first came in, right? As chip and pin was only used in a first few retailers, and it was only a few retailers that were using it, people were more wary of actually doing it. But I think that's one of the things that we need to kind of push. The more people, the more lenders are using this, the better it is, because people will get more used to it. But I think the thing is as well, in terms of the people that are applying, what you're also seeing, and to some degree it's to Alex and George's point in relation to there's other people that can now access credit. So those people who are more used to the kind of open banking things are starting to see the fact that their credit score or their previous information, the bad information that have been maybe historic, or they've got limited information on there, isn't as detrimental, or isn't maybe as detrimental at all as it used to be. We're actually looking at not just affordability, but you can look at their behaviours, what they're likely to spend in terms of their. It's amazing the amount of information, because I used to work in the automotive sector, still kind of do really, that you can get about how they'd behave with your car as well. You'd never be able to get from information in a credit file. You can basically get, okay, well, like, how are you servicing your car? What is the MOT records of your vehicle? All from the information on open banking. So there's a lot more we can do to select the right people.
And I suppose getting access to that data, and we talked about this in the prep for this, was I suppose the split between, and I suppose it links to the last session to a certain extent, using this data to make decisions around whether a loan is affordable or not. I mean, it can be just sort of like prime, subprime, but I think also we're talking a bit about are those the only kind of reasons we now look at in terms of lending money? And there's also this I think Alex, you were talking about ethical decisions as well, right? So we've got an ethical responsibility around whether we should lend or not, and how do we use data and technology to really help us understand that? I mean, Alex, I don't know what your kind of take is on it.
Yeah, so I think I never want to forget, ultimately to the points that have just been raised, fundamentally open banking is helping consumers who are cut out of traditional credit world, and that's a fact. Over 5 million people are credit invisibles right now. They won't have any data with a credit reference agency. Automatically they'll be overpaying, or won't have access to credit. And I think we have to keep remembering the benefit that open banking is bringing. I think the challenge, I suppose, that is starting to bring, and actually to George's point, I love it about how open banking can help product development. So one of the things we learned at Salad from looking at a lot of our customer base is that actually they were disproportionately skewed to weekly salary payers, and hence we launched a weekly product, because actually that better suited their budgeting to support them to repay weekly rather than say monthly. So I think that's really interesting, again, where you can start to learn about your customers. I think back to that point about learning about your customers, the challenge there is that you are starting to see how they live their life, and that in a neat and tidy version of the world, that's going, you get your salary on 28th, and then you pay your mortgage on the 29th, and then etc., and hopefully your money can last you until a point in time. The reality is you're seeing, you bought Deliveroo on a Friday night, you went on, you bought tokens for your kids to play Minecraft, whatever, on Saturday, etc. You're starting, and then all the way through to things like gambling and porn and various other areas of people's spend in their lives, and that is then driving challenges around ethical decisions around if you're aware that you are going to be lending the money and in all likelihood the next day they're going to use it gambling. Is them receiving a loan the right decision? But it's very hard because you're trying to unpick elements of their lives. It might be they're not going to use it for gambling, they're going to use it for their child's birthday, for example. So there has to be a side where there are principles applied in terms of ethics, in terms of decision making. You're taking very much a big brother view of the world potentially.
Yeah, so the data actually might be very predictive, but it actually might be not what they're going to do with it in this time, right? As well, and I suppose the ethics around that, and whether you take a a parental view over it, or whether it's actually their kind of money. And George, I mean, particularly from your experience around from a compliance point of view, how do we start thinking about that? Because it's quite an interesting, gnarly kind of ethical question around when is too much data, it's too much insight versus not, and there's got the consumer side of it, but there's also sort of like where should we be as a society in terms of understanding that, in terms of protecting people from things like fair outcomes.
No, absolutely. And I think Alex kind of hit the nail on the head. I think for organizations, we need to be mindful of the ethical implications, right? The first to think about would be fairness and bias, as Alex rightly mentioned, right? So we need to be crucial about the fact that, this amount of data could bring about this unintended bias, right? And the question is it representative, right? And the decision-making algorithms, are they designed to mitigate those bias and protect fairness, right? So those are the kind of stuff that we need to think about. Transparency is very important as well from a compliance standpoint, so whatever data we gather, right? What does the consumers know about how we're using that data, right? So making sure we're very transparent in that, because at the end of the day, it's also to protect them, but we need to be transparent, and exactly that's what the data protection laws are asking us to do, whether it's consent and the privacy disclosure that needs to be made. So there is a lot of benefits, but we have to be mindful of this unintended consequences and kind of know exactly how to mitigate from those kind of harm to ensure that it's truly beneficial across the board.
I mean, I suppose, and that's true for a lot of technology we're getting into with a lot of extra data. I mean, Justin, you're kind of like nodding your head there. I mean, it's almost like a data provider to a certain extent. I mean, to a certain extent, you're providing it, but does it come into like thinking about what kind of data and what kind of alternative data or data streams we actually make available?
Absolutely. And I think the biggest pro of open banking is it allows you to see your consumers' data. And the biggest con of open banking is it allows you to see your consumers' data, which puts people between a rock and a hard place sometimes, because what you end up doing from a lending perspective is you can see your customer, you can lend to them, but then when it comes to collections, you then have lots of different businesses fighting to collect the bills that they feel they are due at any point of the month. So if you have 5 different businesses, from your phone bill provider to your utility provider, seeing you get paid on the 28th of the month, they'll all be fighting at 3:01 in the morning to try and collect their funds because they know you as a consumer. So I think that's where we come up against the data when it comes to open banking, because if people are knowing you as an individual and as a consumer, they will understand your trends.
But it's almost like interesting what you're saying there is almost like it's like the data as consumers, the data that we provide is actually quite contextual in terms of our comfortness around sharing it. So if I'm looking for a lending decision, I might be able to provide more data, but that data's gone. But if I'm in the collections piece, then typically it seems a little bit more kind of resistant. As a consumer, I might be more resistant, and I suppose that's difficult for businesses to manage as well as for consumers to manage. I mean, Jon, what do you kind of think of that as the problem statement?
It is going to have a lot to manage, and this is the question I always try and think about is like the force implications and the whole thing about if you take in all the data and there's one piece of information which is bad and you haven't taken into account according to us, it is concerning to some degree, but that's the same with any data you take in. But I believe that there is the wins from the consumer side and the wins from the business side are just far outweigh the kind of the risks. And to your point, Justin, and the kind of what Alex could have made in terms of the weekly thing, you can be more clever about setting up the information as well in the right kind of way. So we know from open banking, if you look at people's bank statements and you go, okay, well, I need to get my customer to pay £200 a month. Okay, well, when is the most likely situation during the month that they will have £200? Does it need to be split up into 4 different payments, Alex? Are you saying like in weekly payments? Or can it be like, okay, well, it's a fifth of the month, which is like 2 days after they've paid their, if they've got their income, they've paid off most of their things, I know I can get that successfully. So setting up our customers to actually succeed rather than setting up to fail, just because because quite often just the payment thing can be, well, we've decided because you came in on this date, it's a month, your first payment is a month after this, whenever it was, or that you tell us as a customer which date you want to pay on. Well, people aren't always necessarily sensible in terms of what they choose. I thought it was kind of strange, but I can understand it because people are creature of habit. Is that quite often when you've changed companies and your payment date changes, then because you've set up probably loads of your direct debits around that time, you don't do it again. So their understanding of when is the best time to pay may not be right. So you can use open banking to help them with just something as simple as making sure that they can pay on time.
And I'm going to bring in the topic of vulnerability as well. We talk a lot about affordability and assessing affordability. I mean, how does this kind of data and sort of technology help with things like vulnerability and assessment of vulnerability, or identification of potential vulnerability? I mean, are there tools within there or tools that are out there that we can kind of use? I mean, Justin, I'll just come back to you just because it's sort of like someone who looks after some of the data. I mean, are you seeing it used to identify that as well as just, whether someone can afford it? And it sort of crosses over with that ethical kind of, where do we use it versus not? Because it's probably on the other side of the line. It's like, if I'm vulnerable, most people would say that, well, that's a good way of using it because then you can provide extra support for those folks.
Yeah, communication, right? This is what it's all down to. Should businesses 24 hours before they take a bill out of a consumer's account be checking their account to see if they can afford it? Right? That way, if there is no funds in the account, could they communicate with the customer via text, via email to say, hey, Chris, we've got a bill come out of your account tomorrow. It looks like you have no income in your account at the minute. Is it something you need to look into? It kind of goes on to people have more than one bank account, right? The newer banks that have now come up, you still might have some of your bills coming out of your Halifax account. So you do actually have the funds as a consumer, but they're not sitting within your Halifax account. That prompt could allow you then to send funds over. But that does kind of then move down to the kind of the ethical piece around someone might not have money in their account because they don't want money in their account. So I think communication is key, but then what you don't want is 15 texts a month with 15 bills come out your account, so you haven't got money in the account.
Yeah, I mean, Alex, you talked a bit about the ethical side of when information is too much. I mean, it feels like that's sort of skewed to a certain extent, probably from the vulnerability piece. But do you think there's other things that kind of help there? Because we can look at financial vulnerability relatively easily. I mean, that's relatively easy to look at. But there's other things like, I suppose, mental health or those kind of things. Which I mean, are there technical ways of maybe being able to flag some of these things when you're actually doing lending up front, particularly up front?
Yeah, like a really interesting thing that I've seen with the Salad, which I think is like links to that is that even pre-application at Salad, they have a process where you a customer applying, given the typical demographic of the customer applying, they can go through a benefits checker. So again, they can share their data. We can go through and see, like, are there benefits that they're absolutely legally entitled to receive given their situation, their circumstances, which they should be considering before they even go to credit as an option to try and supplement potentially their cash flow situation. So just even that tool alone, I think that it does link very well to like many of those aspects of potential vulnerability. In the customers in the past year alone at Salad using the benefits checker it's turned out they've been entitled to over £36 million worth of benefits. And you might go, that's really weird. Like you're actually, essentially rather than borrowing £36 million from Salad, we're directing them there. But that, I think, for us, that's much more important that they're on a sound financial footing. They're receiving the benefits that they should be entitled to. And credit is there as a sort of a supplement to that, not, replacing that. So I think that's, and again, that for me is a really nice example where open banking capability can look in and help assess where they should be receiving those benefits they're not, and avoid credit as an option potentially.
It sounds like quite a nice example of sort of like looking after, I suppose, good outcomes to a certain extent. I mean, and you have that question around, is it actually a good outcome for them actually to borrow money or not to a certain extent, and using technology to do that in a lighter way that maybe doesn't cost you as the lender maybe quite so much.
It's a shift in the mindset too, because from our perspective, all of those people who go through the benefits checker, they're customers of Salad, whether they apply to use Salad or not. And it's just different mindsets being like purely a lender, where your mindset is purely like, right, let's try and optimize the accept rate and sort of the approval rate to get them into a hopper to protect our credit, drive our revenue and protect our credit losses. So I think that's a nice example of kind of the mentality of consumer duty starting to translate into the real world, but using technology like open banking.
Yeah. I mean, George, you're nodding there just in terms of I suppose, is that how we're going to have to start thinking about it particularly in terms of consumer duty, fair outcomes stuff coming through and using the technology to almost reduce the cost of the thinking of some of that?
Absolutely. I think what the guys at Salad are doing is just outstanding. I'm really pleased to hear that you're looking at things this way. And I think it's absolutely important when we talk about being a responsible lender. It's not just about I only lend to people that can afford to pay. It's kind of really solving problems and being responsible in terms of even if it's going to cost me business, right? If this person doesn't need to borrow money because I can find them an alternative, right? That is called responsible behavior, right? And that is absolutely outstanding. It's pretty much somewhat similar to something that happened at Loans to Go, where I worked a while ago, whereby when we say no to you, right, we also provide you with all the free debt help advice and stuff like that. So, we're kind of saying we know that we cannot lend to you, but we feel that you need to go get some kind of help rather than just locking the door. And this is responsible behavior. And I'm absolutely impressed to hear this. And this is what technology does, right? Whether it's actually flagging the fact that a customer is applying for a loan on open banking, you can see that they're always gambling, right? What does that tell you about what's most likely going to happen to this particular person? How do you kind of intervene or signpost for them to get the kind of help rather than just say no to them? And I think that is where this big data is going to help us evolve into solving the problems before they even start.
Yeah. I mean, John, I suppose come to you into the thing in terms of thinking about that, in terms of and I suppose using technology to do that and taking a much more holistic approach over the customer or the borrower. But I suppose the other question is going back to that ethical piece in terms of where do we draw the line in terms of when we judge what's being used for? I think Alex, you mentioned it earlier around someone going to use it to buy on something we might not feel is appropriate. I mean, at what point do we actually where do we sort of draw the lines on some of those kind of things? Because we are looking for good outcomes, but we might have an opinion around what a good outcome is.
I think we kind of have to kind of separate off because some of those moral judgments are moral judgments. We have to separate off the things that are just our own moral judgments and the things that really make a difference. Now, a lot of those things, when they combine together, they are a sensible choice. So for things like gambling, if you're doing lots of online gaming, if you're doing cryptocurrency and things like that, whatever. Now, those things, if they're things that are sensible and in the scorecard, then that isn't no longer a moral decision. We shouldn't be taking our purpose here is not to make choices about the customer's moral behavior and whether or not that's right or wrong. I mean, if you see someone spending, all their money on OnlyFans, is that that's fair? It's your choice. But if you've got no money at the end of the month, it's fine. But yeah, we just need to be cautious in relation to that we're only making those judgments where it makes it's a sensible business decision, and it's not just about our views on whether or not that's right or wrong.
And how do we determine, though, whether that's a good outcome or not? So I'm thinking of a scenario where you look into the future and something's gone wrong because someone's got a gambling issue and they borrowed the money as a result of a gambling issue. You might have a moral judgment around whether that's a gambling issue and wouldn't have lent the money. But if they did have a problem at the end, that hindsight's always 2020, where you look back and say, well, look, this shouldn't have happened. How do you determine which ones to look at and which ones not to look at? And because the judgment will probably be always on, judgment will always be on the side of the consumer rather than being on the side of the lender. I mean, I know it's difficult, but I mean, what's our framework for us to think about? How do we do that and make the decisions in the right kind of, the best kind of way?
I'm happy to chip in here, because when I was leading Klarna, I had the real life experience of sort of a media backlash against us offering our pay and 3 options for Deliveroo, for example. And I remember sitting in sort of a parliamentary roundtable, and there was just so much judgment about this. I've heard that they can use it to put their pizza on pay and 3, and again, take a step back. There are absolutely valid use cases where that could be, where a consumer, it's their child's birthday, they don't get takeaway often, and they having 10 kids round, and they want to spread the cost of a £200 order. So there are safeguards you can put in. You can have a threshold where the product becomes available, £50 and above, whatever. So there's sort of product sides to it. But I go back to fundamentally, my argument then was, we've got appropriate affordability, vulnerability checks that we're undertaking at the point of sale. That is, the fundamental of our responsibility. It is not so much a judgment as to then what they choose to use that product on. Like, that was sort of the starting point. Now, I think what we need to do more of, and I think this has been sort of front of mind for us at Salad, is there is an education as to what people are using these products for. And everyone has, particularly if you're in a parliamentary roundtable, a very nice, neat and tidy view of the world. They love the story if you tell them, oh, poor old, Sally, her washing machine blew up. She's a single mum and she needed to get credit to repair a washing machine. They're really happy with that story. They don't like the story if it's like, oh, Simon's decided he wants a tattoo and he's decided to get a loan to get a tattoo. There's a lot of judgment that, again, sort of big brother judgment that goes on there. And I think there is an education point to say that people have different lifestyles and they have different reasons for using credit. And I think to a certain extent, our focus as a lender does have to be more on the side of, assessing affordability, vulnerability, ability to repay, than making lifestyle judgments as to how people choose to, it might be that tattoo significantly improves their sort of mental health, and that's more important to them than, spending it on other areas.
And if you think
Alex,
about
just on that, so just a quick one, that Chris, do we then refer that back to the credit reporting agencies and their purpose in the first place?
Sorry, just explain that to me, Justin.
In regards to the credit reporting agencies, they were looking at it in very black and white, right? And you mentioned there, you go to parliamentary roundtables and everybody thinks the world's a lovely place, and they're not looking at individual basis. This is why we're moving away from just looking at the credit reporting agencies, right?
Yeah, that's my take, exactly. I just think you sort of go back in time. The model has been, large banks hoarding all the data themselves, credit reference agencies, really owning and feeling like they own this data. And that's where I think the exciting part of open banking is, in that it's opening out data, it's driving more competition, ultimately more competition, more consumer choice, better value, you would hope. That should be the journey through. I think on that journey, though, to make sure that open banking doesn't get sort of undermined by those who've got the most to lose, it is our role, I believe, is education of actually, look, the benefits significantly outweigh some of the potential pitfalls, and we'll lean into those pitfalls and overcome them rather than let them be a barrier to this technology becoming adopted on a mainstream basis.
John, you're going to jump in.
Sorry. Just in relation to especially things like gambling and kind of any other vulnerable things, I think one of the things that we can do as lenders, and that we should be doing really, is when we do see those behaviours, taking into account that those behaviours are effectively addictive and just using it as part of the affordability calculation. Just basically going, right, okay, because the affordability calculation generally says these are your costs of living, this is what you need to survive, and therefore anything over and above that, given a percentage or whatever above the gift disposable, is fair game. Well, open banking gives us more information to basically say, okay, well, are they things in that person's lifestyle that they're not going to change? So gambling and any addictive things, whether it's regular alcohol things, if they go down a pub every week, these things should be taken into account in the affordability calculation, because if they're in a bad situation and they're not going to stop paying those, we need to take that into account. And that's how we can take into account some of those vulnerabilities without being morally judgment about them. So basically just saying that we know that given a bad situation, you'll continue to spend money on whatever, gambling, whatever, or the one I quite often use is Zebra, who used to do really well in terms of Zebra Finance. It had a 99% pay rate on, despite the fact that they were subprime loans, because of a season tickets. Well, if I see a season ticket on especially for the big clubs, on someone's current account, I just presume they're going to pay that all the time. Yeah. So I take that out of the affordability calculation. There's no point me basically saying that in a bad situation, this person is going to continue to pay their mortgage and their credit cards. If they've got a Manchester United season ticket and they haven't got much income, they will lose their house. And they will lose the credit card and everything. They will sit in their car and survive in there to pay their season ticket. So it's just taking into account where we can those vulnerable elements in the affordability calculation.
And just really briefly on that, the bit that which I absolutely agree with you on, John, is that we're using that data in a responsible way to feed into an affordability assessment. What we're not doing is making it, say, a policy rule that means the start point of the decision tree goes, John Gamble, that's a no. And I think that's what, if you look to traditional credit data, that's that model of like county court judgment. Yes, right, you're automatically declined. Like you don't even go in the hopper
exactly.
to be assessed.
We're making reasonable judgments, not moral judgments.
Yeah,
it's quite interesting just on affordability assessments in terms of like the stickiness of different items, particularly if you're looking more sort of like back end in terms of like people in difficulty and those kind of things, in terms of like which ones are sticky versus not, which ones people don't want to cut back versus not. I mean, do you think I've not really heard that explored quite so much. It's interesting in terms of like how you'd actually look at that, particularly get open banking information. If you get all this like the detail of it, or some of these alternative kind of elements. But even then, if you look at things like the SFS statement, I mean, the ones that I always like is haircuts, because I need a haircut. I mean, if I'm spending £500 a month for my haircut, I mean, most people would say that actually, you need to cut back a bit. But is that kind of a moral judgment or not? I mean, you get into that. I mean, that's just a silly example, but you get into those kind of discussions, don't you? And you do when people are in financial difficulty. I suppose the question here is, do you need to do that in the underwriting process under affordability? I think the complexity for me just sort of becomes almost like heightened as a result of consumer duty and outcomes and those kind of things. I mean, how do we think about it? I mean, George, how do we think about how all this links together? I mean, I've got these thoughts going around in my mind now in terms of the complexity we've got to consider. I mean, is there a simple way of us sort of thinking about it, or sort of staying grounded in terms of how we look at affordability? Or you're on mute again. Come off mute.
Sorry, I'll probably stay off mute going forward. Yeah, I think a point John made, reasonable judgment, right? So the way I look at it, from a lawyer standpoint, you look at foreseeability. What harm can be foreseen? Right. And if you can foresee harm, then you have to do something to prevent it. Ultimately, as lenders or debt collection company, the two things you're trying to prevent harm for the business in terms of making the wrong judgment and lending that you cannot get the money back, right? Or preventing harm in terms of to the consumer. They become overcommitted, and then it causes harm beyond what we can even foresee. So it's pretty much figuring out, based on all the information and all the potential risk, which some are personal and it doesn't really mean harm. Most people, when I was in the lending in the UK, some people do not want, when they ask for their disclosure of their data and they see a flag of vulnerability, they're not happy, right, for you to class them as vulnerable, right? Whether it's by age or whatever, some people would take offense, right? So, people wanting to gamble, if they want to carry on gambling, is fine. But there has to be a way for you to say, whether it's based on big data and what you've seen in terms of characteristics and trend of different people of the similar characteristics behaving that way, that tells you that this person, based on what we're seeing, this is where it's most likely going to go. Then we need to kind of figure out how we're going to prevent that. And if there isn't any way to do that, it's not our business, right? And I think that's the way to do it. Just, and for me personally, if I can speak openly in a pub about the steps I take to lend people money, and I can openly say it, then it's probably right. If I cannot say it out, then perhaps it's one to think about again.
Yeah. That's a good way of thinking about it. And I suppose we talked a lot about, I suppose, open banking for things like affordability assessments or affordability, maybe even vulnerability kind of identification. The other aspect we're going to talk a bit about was payments, right? So once someone's actually then, they're already a customer, you know, they're obviously making payments. I mean, is there insight we can get from the payment stream? And Justin, I'm going to come to you there around. And I think earlier it was mentioned around sort of matching paydays as an example as being a potential opportunity. But insights around how people are paying, frequencies of paying, dynamics around that. Is the data that we're missing there that can actually be useful in either extending further credit or not, or those kind of things? I mean, do we make enough of it?
Yeah, it's a good question. I think the pool of data is huge and is probably not being utilised enough right now. Understanding why transactions have declined, we think from an acquired perspective, our job is to support our lenders in collecting payments. So when collections go through, people don't really look at what's more important when transactions have declined and why have they declined. Has a collection declined because that customer doesn't have the funds in their account, or has it declined because the card's expired? That's two different ways of a decline going through. And what's the rule then of that lender off the back of that? Are you reaching out to a customer to say you don't have enough money, or are you telling them your card's expired? And what's the customer journey off the back of that? I think the time of trying to process a collection, if you're trying to collect a payment at 1 o'clock in the morning and it declines, you're automatically thinking that consumer doesn't have the money, but actually it's because they're paid at 3:08 a.m. by their bank. And actually, by the time you've contacted them, they've already got the money in their account. And where we don't want to fall into is just trying to, the old Wonga days, is trying to take payments every single 15 minutes from that consumer. So how are we utilising the data behind that? Here at Acquired, we've been working with businesses now for the last 9 years in regards to understand the real data behind the declines. It's so important. Businesses haven't done it enough, but I think maybe because they don't know it's out there, as opposed to just being blind to it.
And I suppose even on open banking, so you're not going to get to see the declines, but the decline data becomes useful in terms of understanding what the customer profile looks like.
Absolutely. And if you look at the open bank, if you've got someone who's on a payment streak in inverted commas, and they've been paying now for the last 12 months, are you utilising open banking to see if that customer can lend further? Should you be asking that customer if they want to lend further? Or actually, you've seen their credit file and think this customer doesn't need to borrow anymore. It all comes to risk versus reward.
One of the examples came up in one of the previous think tank sessions we had was like order of payments as an example. I mean, Alex, I think it was actually Salad that was doing it. Like looking at order of payments or changes in orders of payments can be potentially indicative around changes in financial situations as an example.
Yeah, I mean it's really interesting, isn't it? Because like all these kind of new technologies, the starting point has been very much origination, application stage, utilization. Couple of ways interesting other options we're using at Salad. One is around looking at that, re-looking at the data a couple of days before payment date. Can you then proactively offer them forbearance measures, for example, to support them pre the payment date due? Again, when I was at Klarna, we had a sort of a snooze capability that was similar, where a customer could proactively choose to snooze their payment by, for example, 10 days. Like another one though that I really like on the repayment side is the starting to use for, say, the weekly product at Salad is starting to use, for example, these sort of smart direct debits, the sort of the next generation of open banking powered direct debits under sort of the variable recurring payment type model, where again, if you think for weekly payments, traditional model with direct debits, by the time you get notified that the payment hasn't been successful, and then you try and represent, you're tripping over the next payment the following week on weekly. So the data is like very traditional direct debits. The data is very like delayed, and so again, really interesting this kind of concept of being able to use open banking powered smart DDs to try and get a faster feedback, where you essentially get immediate insight as to whether that direct debit's failed or not.
It's also interesting about the acceleration and the frequency which we look at things, right? So we're changing from being a monthly cycle down to weekly cycles or daily cycles, or even just you're just saying there as like timings around versus payments versus not. With this time frames getting shorter and shorter and shorter as we get more information and more sort of like real time kind of data, really. John, what's your kind of perspective on such a timing and acceleration around that?
Yeah, I think timing, especially for those kind of customers, companies that have got the that have constant interactions with the customers. So like salad money, it's quite frequent. If you can get it to the point where it's within that 90-day period that you're allowed to have access to the open banking, you can basically potentially be constantly monitoring those kind of customers. So we don't even necessarily have to even have it that you have to pay on a particular day. If you can see from their open banking that they haven't got the money, you can contact them and go, look, we didn't take the payment. We're not even going to try because you haven't got the money in there. This needs to be paid. When is the best time to pay it or whatever, or use this link or whatever to make the payment when you have got the money there. And the flip side is, and they're like, well, if you know the customer's got a lump sum payment for the same kind of thing, they got a bonus from work, they got a gift for Christmas and things like that. It's a classic one for especially kind of like the high interest loans perspective. Then it's basically like, well, do you want to pay this? We can see this is money coming in. I'm not saying you have to, but do you want to pay it early? Because either you can reduce your amount of interest you're paying, or you can basically have no more payment from us by basically paying it off. We can, if we understand more about that kind of the live customer base, we can understand what they can do. And again, it's the same kind of thing. Like if someone increases their wages, if their wages are basically they've got a 10-20% increase in the wage, brilliant. Do you want to pay off more of your loan? Because at the moment you're paying £50 a month. If you paid £80 a month, it'd be paid off earlier, and you'd save the amount this much of interest. If we have that kind of relationship with customers where we're using that information we're gathering to have the best payment scheme for them.
Yeah, so it's almost like using the information to better understand them. One of the questions actually came up in the last one I want to bring forward to this session here is we talk about increasing frequency of monitoring, increasing frequency of payments, greater digital engagement as an example. And the other hot topic that's out there is fraud, right? So be it notifications like, and one of the questions we had in the pre-work was around things like payment links as an example. Where does fraud fit into this? Because as much as we might be sort of digitally using technology and sort of like digitally becoming more advanced, the potential is out there for fraudsters to potentially do that as well. And how do we protect that? And do we see any kind of like reticence from almost like the consumers sort of reacting against that? I mean, and there's even been stuff on TV, I think TV shows recently, sort of talking about, I mean, how do we protect ourselves from fraud at the same time as we're using all this new kind of tech, really?
I'm happy to take that one. Yeah, it's an interesting one because we've always been taught, for me, most of my life, don't open spam texts, don't open spam emails. It's probably going to be fraud and someone's going to take all your money. And now we're moving to more of you're going to receive a text. And I think the reason for that, yes, it is a generational thing. But also, if you have an ongoing relationship with your provider, it's not a one text out of the blue that you're receiving. So you would have communicated with that business well before that asking for a payment. So it could be a text welcoming you to them as a business, as a new customer. When you sign up, you could be told, we will reach out to you via different communications like text, etc. It really is educating the customer and us as individuals on what we've been told not to do for the last 20 years.
But so it feels like it's coming down to that relationship piece. I mean, Alex, some of the stuff that even some of the stuff you were talking about from a data point of view, it's like, how do you build that relationship? How do you understand the customer? But then probably that's a bit of a two-way thing as well.
Yeah, I mean, I think the lesson from my time at Klarna was trying to keep people in that sort of and feel secure in your ecosystem. So for us, like the Klarna app was their ecosystem. That's where they operated. It would be whether it was like push notifications via the app, etc., that would support them, that gave them that reassurance of, like myself, you're in a rush, you get a message, it says this payment's due for an invoice or something, like there can be that temptation to click through and suddenly you're paying a link to something that's completely fraudulent. So I think there are methods that you can do, and I think like that use of like within an app for the provider can be one mechanism at least of consumers to feel more secure. The frustration here is that fundamentally, again, sort of open banking, I see it as a more secure method ultimately than other channels, particularly when you can use sort of authorization through like biometrics, etc. The name doesn't, just the name open banking. Like if I say it to my parents, it's like red flag. It's like everything that would worry about in terms of as a name and a concept of sharing more data. But I think ultimately the security side of it, the fundamentals of it are more secure. I think that what we need to combat is, to Justin's point, is the text, the email, where you can suddenly, very easily be sent a link and be, essentially you authorizing it from your account. I mean, the challenge back to that is you go into, your app, and when you're doing open banking payments now, and the pain, I have HSBC as an example, the number of things I'm ticking where I have to say what I'm paying for. Do I approve it? Do I approve it again? Do I approve it? Is it definitely not a scam? They're having to do that to sort of protect themselves from being, at fault. But from a customer journey side, that isn't great. It does feel quite laboured and painful. So I think trying to, keep consumers safe, it's a constant trade-off between keeping them safe, but not putting so much friction in that these tools, you've basically broken them in the process of trying to keep people safe.
Yeah. And it feels like some of it comes down to that trust. I mean, the theme coming through here is trust, right? So it's trust. Are you building an ecosystem or an app or a thing that adds value and the consumers trust? And that trust takes time to build. We even saw that with open banking sort of adoption, right? And it's like, how do you trust them? How do you then send trusted links? And just sort of, focusing on that in terms of like building better relationships. I mean, George, what's your kind of view on the kind of that really, I suppose, in terms of like the role of trust within lending, right? And do we spend enough time thinking about that versus, default rates and fraud rates and those kind of things?
Yeah, I'm not. I don't know about whether we do enough, but it's pretty much falls under, I would say, conduct risk, right? Because as this innovation, whether it's affordability related innovation, they all rely heavily on technology and digital platforms, right? And that means that they're all susceptible to cyber attacks and hacking and all sorts, and also fraud, as you've rightly mentioned. So for us, the conduct risk, therefore, is what are we implementing? Do we have robust cyber security measures to prevent those kind of attacks? But also from a consumer duty standpoint, how much do we do to educate the consumers that we're carrying along on this journey to meet their needs, right? This is ultimately one of the things we do in our business in Nigeria and Kenya, and that is sending enough information, educational information on all the risk and the fact that we'll never ask for your password, we'll never send this link and all this kind of stuff, because a lot of people that have actually been scammed is because they have no idea of the risk, right? They don't know of all the things that are going on because no one has actually told them. So taking that responsibility to know that, look, this risk is foreseeable, going back to our point in terms of foreseeability, how do we prevent our business? So having the right measures and controls in place, right? And how do we also educate the consumers to protect themselves as well?
Yeah. I mean, I suppose the education element. I mean, the reason why I mentioned fraud, I think it was there's a story this week. I think the banks were reporting back to one of the parliamentary committees, or there was a meeting there, and sort of like saying, the amount they're having to underwrite from a fraud point of view, and it's getting almost like the problems becoming so prevalent. What you're saying there is kind of interesting in terms of that education element. And John, maybe just comment there around like, do we do enough around that? Is that something maybe that should be a growing area? And then also, what's the role of technology to then help educate people on a wider basis so you can do it a little bit more cost effectively?
Having been a member of CIFAS and the committee at some point now, I can tell you that we can do all kinds of things. We push it as much as you can, spend millions of pounds on trying to educate the society on fraud. And unless we got Martin Lewis to actually say it, I don't think many people will listen to it.
So Martin Lewis is the key.
Well, yeah, basically, to get Martin Lewis to say about it, everyone that really needs to know will listen and will hear it. That's the only way I've seen anything successful in terms of thinking like the National Fraud Database, something like that. I've been going for a number of years. I've asked whenever tried to push it. Doesn't really get out there. The only other successful campaign was Experian, because they wanted to sell the product in terms of fraud. But again, just normal communications, it doesn't really get out there. I think just to your point, George, in terms of like just sending out messages from you saying, this is how we will communicate with you. If there's anything outside of that, don't do it. It's the only thing we really can do in terms of that. But I think from the opposite side in terms of the customer committing fraud or potentially. I think there's really good things about open banking that it's very rare that we'll see now. So like impersonation fraud using open banking, as long as you're basically checking the account's been open for a certain amount of time, it's virtually impossible. Right? It's good because bank security checks and things like that are so good that you're basically relying on those. The other thing is that I don't know how many of you know about how bad Cato is, but the information that people are using if they're making an affordability decision simply on the basis of the information on the person's credit file is basically the information from the current account turnover information and some information from the ONS. Now, I'm not dissing the information from the ONS in terms of your affordability, but the Cato system, the current account turnover, is incredibly fraudulent. Some mostly unknowingly so. So someone basically puts an application through and they basically put whatever they think is their current income or whatever it wants it to be, whatever they think it should be to pass whatever rules they believe the bank has got. Now, that system basically checks the amount that's gone into your current account and verifies whether or not the amount that's gone into your current account is similar to, less than, or equal to the amount that they've given on the application, presuming the normal tax or something like that. But 80% of the companies that provide information to them, or somewhere out there, they just literally report everything that's gone into the current account. Transfers, the return direct debits is all taken as a payment into the current account. So you could say, I earn £80,000, and then it's fine because you do. On open banking, we can see it. Or that same person could say, well, I earn £8 million, because all they have to basically do to pass Cato is to send a certain amount of money from their current account to savings account, current account, savings account, do it backwards and forwards, and they're earning £8 million according to Cato. So some of those kind of things that some of the elements of fraud will be virtually non-existent going forward, which is good to see. And obviously, it's not just an impact on the finance providers; it's an impact to the consumers as well, because a percentage of the interest that a person's paying, or the fees that they're paying, or the fees that retail are paying, depending on how your model works, is to do with the amount of fraud that you're having. So if we're reducing that, then it's a customer benefit as well.
Yeah. So it's interesting in terms of, like, I suppose, how we then adopt the technology and some of the data that's going into our models, and just some, like, as we get more data, it becomes more complex, and we've got to be careful about how we kind of think about it, I suppose, because there's some dangers in the, almost like the nuance of it. I think, John, is kind of way is what you're saying is, like, we've got to understand those nuances so we don't make blanket decisions elsewhere, and it becomes more around that relationship kind of elements too. I mean, so conscious of time here, we're almost at time, but I suppose it was, where do people think that this whole field will sort of go in the next sort of, like, I said on the last call 5 years, and everyone said it was way too long now because everything's just much shorter time frame, but maybe it's the next year or 18 months. I mean, where do we think the lending market and lending technology market and data, etc., is really going to, what's going to be the focus over the next sort of, like, 18 months or so? I mean, Alex, you're nodding.
So, like, I've got sort of wearing my other hat. So I sit on the board of the Centre for Finance, Innovation and Technology, which is a government-backed body to champion UK fintech. And we run coalitions where we bring regulators, policymakers, industry together to try and solve difficult problems. And the one area we've been looking at recently was open finance as the evolution from open banking, and looking at additional data sources that we can bring in and the value that can bring to both consumers and businesses. Just issued the report recently, it's worth having a look, but a couple of really interesting sort of proof of concepts, prototypes that came out of that. One was looking at SME lending, which is proving to be really challenging at the moment, sort of the risk appetite of banks, etc. And we did some work with HSBC and Experian there, where we looked at other data sources that could come in that could reduce manual referrals for sort of manual underwriting by 25%. Great news for businesses, faster decisions. The one more relevant in a way to this conversation, though, was did some work with Citizens Advice, where we looked at their process for supporting the consumers who are most in need. They have understandably, they need to gather a huge amount of information to produce essentially for one of their case officers to support a consumer. Hugely, process-driven, manual, time-consuming. We looked at building a prototype dashboard with them, which could bring in data, whether it's from new source of data like HMRC, other products in their life, whether it's savings beyond just current account data, even transactional data within credit cards that most of us wouldn't have visibility to. We'd only see sort of the balance usage with credit reference agency data. That could mean that, for example, Citizens Advice could support 150,000 more consumers with the same level of resource, and their team are focusing their time on where they add the most value, which is the advice based on the data, rather than trying to take all these data sources, assimilate it, and put it together. So I think it's hugely exciting, the potential of that evolution, open banking to open finance. I think the challenge for the UK that we're really working on is the UK really has been at the forefront of open banking development. We probably have given up some of that sort of head start we had to other countries around the world. And we see sort of whether it's sort of Brazil, Canada, Australia, and obviously places like Singapore progressing ahead of the UK. And I think what we're trying to push for with open finance is that we don't end up sort of behind other countries, and that we really bring those benefits and set the standards in the UK, and they become the global standards. So exciting. I see that as a sort of next evolution, even more data, place all the challenges we've discussed about making sure it's used in the right way.
Yeah. George, what's your kind of predictions for the future, I suppose?
Yeah, pretty much in line with Alex. I think we would see more flexible lending products as a result of the points we've already discussed today. There's going to be alternative credit assessment, again, as we've discussed, where the traditional scoring models become less dominant as lenders would start to look at alternative data. So we can expect that as we're already seeing. I think we'll see a lot of collaboration with fintech. Again, we're seeing that, we're doing that. You know, the point you made about payments, fintechs providers partnering with lendtechs, right? So that you could actually leverage on data to know exactly when to intervene, when to provide credit, and all those kind of stuff in a very, very mitigated risk position. So we're going to see all this kind of stuff. For me, financial inclusion is very, very important because I've been one of those that have actually been affected by that kind of exclusion. So I think we're now starting to see improvement because there's access to more information and data. So we're going to see that evolution, if you like, in solving financial inclusion, which is a big problem.
Okay, interesting. And John?
I think the thing that we'll see more and more of now is that we'll see some of the marketing spend that has been going on before spent on using the data better to actually approve more of the people that you're getting in. Because I think a lot of companies are basically seeing that they're having this marketing spend. A lot of it's not really going anywhere and getting the kind of customers, but they've actually got huge amounts of customers coming through the door, most of which are not approving. So I think there'll be more and more focus to use open banking, other kind of interesting data sources, and better scorecards that are actually fairer, that actually mean that more people will get approved. Because I think that the more you lean on a traditional scorecard that's kind of credit file based, the more you're going to be leaning to the middle of that bell curve. But then most people don't live in that bell curve. But that's a peak in the middle of people that have got enough money and are nice secure. But there's a lot of people on the outside that these people, the lenders are already actually attracting in. So I think there'll be more focus on using taking away the marketing spend and using it to actually get more people on board.
And then lastly, Justin, I mean, where do you sort of see the next sort of 12, 18 months sort of heading?
Yeah, I think for me, it's twofold. You mentioned there, John, on marketing. I think we need to maybe stop using the term open banking because it makes people a little bit nervous, but actually use the marketing piece that we're doing instead of trying to get customers to the front end, but showing them what it means in the back end, showing them and marketing the answers of open banking as opposed to what it can offer them, show them what is offered other people. And the data around that, I think that will then build credibility and trust for us as consumers to see the word open finance and go, yeah, that I want that because I know it's going to allow me to live a better future. This is why I'm here in the first place. So be kind of marketing on the back of that.
Okay. Well, thank you to Alex, George, John, and Justin for joining the panel today. Super interesting ideas. Thanks very much for all of the insights. Really appreciate it. So thanks very much. I'm going to hand back to Colin. Well, you're on mute, Colin.
Thanks, Chris. Sorry. Yeah, I got caught
Okay.
out there. Yeah, thanks for that. Yeah, no, really great, guys. Thank you so much for the insight. It's really good. Some new angles heard there as well about open finance and stuff. And interesting to hear about the overseas approach as well. Really great. So thank you, everybody, for that. Just want to end really by rounding up and saying a big thank you to all of our speakers from the session earlier as well. That was really excellent. And of course, Chris for chairing this session as well, and the speakers in the session. That was great. Just want to flag up some other events that we've got coming up. There's a link in on the panel on the screen in front of you where you can click, and it'll take you to all our upcoming events. We've added a couple of new ones recently. We've got a Credit Collections Industry Awards deadline coming up. We've got a commercial event for anybody involved with business lending. We've got a think tank and a working capital group in May and July, and then we'll come back to the virtual credit and collections think tank in June, and then we've got a lending technology think tank in September, and then we've got our face-to-face big event, which is our credit and collections think tank on the 7th of November at the Midland Hotel in Manchester. So we hope people will join that and hopefully enter our technology awards this year. But yeah, no, let me end by saying a big thank you to the speakers in this session. Obviously, Alex, John, George, and Justin for their insights, and of course, Chris for all of his work across all the sessions today. I'd like to thank our sponsors who made today's possible, Acquired and LexisNexis, for that. And hopefully, we obviously thank you to everybody who's tuned in today, and we hope to see you all at a future event. So thanks everybody for your time, and hopefully we'll see you all again soon. Thanks a lot. Cheers. Bye-bye.
Thanks.
Thank
Bye.
you.
Bye.
Bye.
Bye.